Africa has to earn the U.S. dollars, and the only way it can earn the U.S. dollars is not to be assassinated for growing its own food.
When Ghana's delegation walked into the IMF headquarters in Washington in July 2025, the atmosphere was anything but business as usual. The country faced the possibility of losing vital program support, a situation fueled by one of its most precarious fiscal episodes since the program began. Once considered a showcase of economic reform in West Africa, Ghana had stumbled, and badly. In the final quarter of 2024, pre-election spending had soared far beyond the IMF program's agreed limits. Infrastructure projects were fast-tracked, civil service bonuses expanded, and fuel subsidies reintroduced, all textbook moves to curry public favor ahead of a fiercely contested national election. But these populist measures came with severe economic consequences. Fiscal gains earned through hard reforms early in the program were almost completely reversed in a matter of months. By late 2024, government arrears were piling up, public debt was glaringly off track, and the deficit had widened to an unsustainable level. Most worrisome, the trust between Ghana and its international partners began to erode. The IMF's warning signs had gone largely unheeded, and the fourth review of its $3 billion extended credit facility, which should have been a procedural milestone, suddenly turned into a high-stakes moment. Faced with these hard truths, the fund braced for the worst. A number of countries in similar positions had seen their IMF programs suspended. The risk for Ghana was real. No more disbursements, plummeting investor confidence, foreign exchange shortages, and a potential currency collapse. But then came a surprise that few, even seasoned observers, anticipated. That Ghana's newly elected government did something rare in both local and international politics. It admitted fault. Rather than defending the reckless spending of 2024, the administration acknowledged that the pre-election fiscal spree had destabilized the country. More importantly, it presented a bold and credible plan to restore discipline. The new 2025 budget was aligned with IMF targets and included a commitment to achieve a primary surplus of 1.5% of GDP, Ghana's most ambitious fiscal goal in recent history. For the first time in years, spending ceilings were closely tied to actual revenue performance. These weren't just theoretical reforms framed in technical jargon, they were enforceable measures designed for real-world application. The IMF's response was swift and telling. Against expectations, it approved a new disbursement of $367 million, sending a strong signal to markets. Ghana was still a country worth backing. It wasn't just financial aid, it was a vote of confidence in the country's political will to fix its mistakes. Credit ratings quickly reflected this shift. Agencies raised their outlooks, and bond yields began to ease after months of climbing. The beleaguered Ghanaian cedi found breathing room as currency pressures momentarily relaxed. In business hubs from Accra to Takoradi, the short-term relief was almost tangible. But the deeper story was more complicated. IMF-supported programs are almost always controversial on the ground. While they often restore economic stability, the path to that stability is paved with harsh sacrifices. And Ghana's 2025 reforms brought precisely that. Higher taxes, removal of subsidies, spending caps, and an independent audit to vet billions in 2024 arrears. Contractors, civil servants, and low-income households felt the brunt of it. For people waiting on long overdue payments, some of them dating back to early 2024, the wait continued. The audit might confirm which bills were legitimate and expose fraud in the rest. Either way, these revelations wouldn't solve liquidity needs overnight. Worse still, some of the poorest Ghanaians began to feel left behind once again, facing higher transportation costs, electricity bills, and reduced access to essential support services. The IMF acknowledged that Ghana's economic vulnerability was closely tied to its political cycle, a long-standing pattern of pre-election spending sprees followed by painful fiscal corrections. If the cycle repeated yet again, the program could unravel, and market confidence would rapidly evaporate. But for now, Ghana had bought precious time to stabilize its currency, rebuild reserves, and prove itself credible enough for future investment. To understand how Ghana got here, you must look back to how 2024 unfolded. At the year's start, the IMF program seemed on track. Inflation, while high, was showing signs of retreat. Investor sentiment was gradually improving, and the country was making slow progress on debt restructuring. But as the 2024 election drew near, Economic discipline gave way to political calculation. Infrastructure projects ballooned, salaries and subsidies were expanded, and fiscal rules were blurred. The result? A massive funding gap that the domestic market alone couldn't plug. The government was forced to rely on short maturity, high-interest financing tools that quickly began to crowd out private sector lending while inflating interest payments. Arrears mounted and international bondholders queued behind a growing line of unpaid local contractors. Currency depreciation soon followed, intensifying inflation and squeezing households. Debt servicing costs soared, credit downgrades began to roll in, and IMF officials grew increasingly skeptical about whether Ghana had the political will to stick to its reform plan. By the time the new administration took office in 2025, it had inherited not only a mandate to lead but also a full-blown economic emergency, and yet, what followed was arguably one of the bolder reform resets in recent African economic history. The reform package addressed not only fiscal balances and deficits but deeper structural issues: weak tax collection, bloated public payrolls, and opaque procurement. The inclusion of an independent audit showed the administration's willingness to confront the messy legacy of past decisions head-on. Markets took notice. And so did other African nations, countries like Kenya, Egypt, and Zambia, all facing similar dynamics of election year fiscal slippage, watched Ghana closely. For them, Ghana's bold corrective effort was both a cautionary tale and a blueprint. It showed that falling off track doesn't have to mean losing the IMF support, but only if governments are willing to take politically risky, even unpopular, decisions quickly. But the cost of these reforms inside Ghana has been steep. Transport fares have increased due to fuel tax adjustments. Property taxes, once ignored, are now strictly enforced. Electricity bills have edged upward. Rural areas are already feeling the effects of the gradual rollback of agricultural subsidies. While these policy changes are functionally sound and supported by economists, they test the patience and resilience of ordinary people, especially when food and basic services become more expensive. Labor unions are growing restless as wage growth is deliberately restrained under the IMF program. Sporadic protests in urban areas, some bearing signs that accuse the IMF of choking the population, reveal a deeper psychological resentment about who is actually calling the shots. The government's narrative of necessary sacrifice is competing with populist claims of external interference. Opposition parties have seized the moment, framing the IMF deal as evidence of lost sovereignty, and warning that Ghana is repeating old mistakes. On social media, debates about national dignity, foreign dependency, and the burdens on the working poor rage on. Still, there are voices that urge a more balanced perspective. Some analysts, policy experts, and civil society groups argue that the reforms, while painful, were inevitable. They point to the hard-won improvements in ratings and dampened borrowing costs as proof that the global market is beginning to believe in Ghana again. But what matters now isn't whether Ghana has shown it can take decisive steps. It's whether those steps can be sustained. Achieving a 1.5% primary surplus in a single year is one thing. Sustaining it in an election cycle, amid competing fiscal pressures, is another. Tax compliance remains a hurdle, especially in the informal economy that dominates rural Ghana. Expanding revenue without strangling enterprise is a delicate policy task, one that will decide the fate of the recovery. Meanwhile, debt restructuring, particularly with private bondholders, is ongoing. Until those negotiations are resolved, Ghana risks remaining partially shut out of global capital markets. Without new capital flows, development spending could continue to slow, affecting long-term growth. Global conditions add another layer of uncertainty. As a commodity-dependent country, Ghana's finances are vulnerable to fluctuations in cocoa, gold, and oil prices. A sudden downturn in commodity prices could upend the fragile recovery. Likewise, global interest rate shifts may make borrowing more expensive once again, complicating Ghana's fiscal outlook. The most important variable, however, might be domestic politics. If public support for the reforms erodes, or if opposition forces succeed in derailing the plan ahead of the next elections, all of these hard-won gains could be reversed. That's why this moment matters. Ghana has pulled itself back from the edge, but the structural weaknesses that made the crisis possible are still in place. The real challenge now is execution, transforming promises into policy and ensuring that reforms last beyond the current political window. What happens next will shape not just Ghana's future, but the fate of IMF programs across Africa. The world is watching. Will Ghana chart a path towards sustainable reform that others can follow, or stumble once again just as momentum returns? Let us know what you think. Has Ghana taken back control of its economic future? Or is this another short-lived cycle of foreign dependency? Is the IMF helping or holding Africa back? We'd love to hear your thoughts in the comments. And if you enjoyed this deep dive into one of Africa's big economic turning points, don't forget to like, share, and subscribe. We're committed to unpacking stories that matter to Black lives, Black voices, and Black futures. Until next time, stay tuned.